In the Fed's latest move, they raised interest rates again for the 10th time by 25 basis points, but dropped a subtle hint there might be a slowdown going forward. Their statement omitted a sentence that was present in the previous statement, saying the committee anticipates some additional policy firming may be appropriate for the Fed to achieve its 2% inflation goal, but also said further tightening may be needed. So what happens now? Is this bullish for stocks? Are they signaling a pivot? Can you make money anyway? Let's talk about it. All right, guys, welcome back. So I know you both have strong feelings about the Fed. That's apparent in our most recent video we posted. But let's go ahead and talk about how to invest or trade this market. Can we say that a pause would be interpreted as bullish, or is that more of Fed speak?
Right. I think this is definitely a hawkish pause. I mean, I honestly thought they were going to indicate, or that they had already indicated, that it was going to be one more hike and they were done for the year. But the statement definitely left open the door for another hike if they needed to do one. They certainly have not indicated any need to reduce rates. So even if they do pause, it's still very hawkish. We're going to be in a high interest rate environment for a long time. We are definitely in a new normal. And I want to point out, Gunlock made a really interesting point. I saw him on the news yesterday, is that money is coming out of equities because of interest rates. Equities aren't returning the same rate that you can get on treasury yields. And that situation is going to continue until yields come down. So for the market, it's absolutely a bearish headwind.
Chris, what's your take on that? What do you have to say for that?
Well, in general, I agree with Thomas. I think it was a hawkish pause, and I think that the Fed, in the remarks that Powell made, he was certainly leaving room for raising interest rates later in the year. However, I was doing some reading last night because I knew we were going to be talking about this today, and I saw something that made me rethink things a little bit, and that is that according to a lot of analysts, I guess, and the institutional investors, they're saying that there is a 0.4% chance that interest rates will stay within the 5 and 5.25% range by December. And they're not talking about interest rates going up. They're talking about going down. And I want to repeat that number. I'm talking about not 4%, not 40%. 0.4%, less than 0.4%, are saying that interest rates are going to stay where they are. And the consensus is that interest rates could move down 75 basis points by the time Santa comes down the chimney. That's not me saying that. I'm saying that's what the data is saying after the Fed announcement yesterday. So take it as you will. That may be more bullish than some investors are thinking.
Right, because maybe some people are thinking that this economic storm is getting ready to happen between now and Christmas. It's like we're on the brink of recession. The economy's slowing everywhere you look. We talked a bunch before in our videos about the index of leading indicators and how they've been negative for over a year and they're trending lower. All of a sudden, yesterday on the news, after the Fed announcement, every single talking head is talking about the leading indicators and how negative they've been and how they're trending lower. So, recession. I mean, it's knocking on the door. It's right here.
And I think in the short term, and this is, Lacey, why I think investors it's always really difficult to be trading. I generally don't make any moves in my portfolio during Fed week, or at least until after the Fed makes their announcement, because it's really easy to become prisoner of the moment here. And I think in the short term, there is going to be some downward pressure on stocks. Yes, there's the ongoing news about the banks and what's happening there, but just in general, now that investors, the institutional investors, know that there's a fairly good chance that interest rates are at least going to stay where they are for some time, maybe throughout the summer. They're going to aggressively try to price stocks accordingly. That could lead to some bargains down the road as stocks become more attractively priced and starts luring some cash off of the sidelines. But we'll see.
All right, you talked about the pricing of stocks. Let's talk about some individual stocks here then that would come into play. Where do we need to be looking?
Well, where I'm looking now and where I just think is the best place to be are in blue chip market leaders. The blue chip market leaders in every sectors appear to be the winners. They're all outperforming. Say that kind of in a general way. I'm looking really heavily at the consumer staple stocks. You know, I love those guys, but dividend growers, they're all seeing solid support. And one of the ones that I like the most right now actually is PepsiCo. We talked about that one a whole lot.
You love PepsiCo, Thomas. We know that. We've done videos on that.
Right.
So we know you love it. So tell us again, what makes that stock so attractive to you?
Yeah, it's funny because I choose Coke over Pepsi at the store any day, but PepsiCo for the investment is by far the better choice. I think it's the largest consumer packaged food company in the world. It's got huge pricing power. It's got great reach. They're still growing. There's just really nothing not to like about them. Their last report came out last week, 2 weeks ago. They outperformed. They raised guidance. The dividend's fantastic. The stock broke out to a new high. The analysts all like what they saw as well, and they're looking at price targets. Yeah, so PepsiCo is a great example of these blue chip leaders and how they're kind of dominating the market. Because like the post-pandemic world, a lot of the smaller players are out of the game, and it's a lot of consolidation. And now these big blue chip companies that have the leverage to operate are able to consolidate where the smaller players aren't able to.
All right, Chris, both of you seem to take positions of caution here, and I'm not sensing a lot of optimism with either of you. Am I wrong?
I don't know. I don't know. I don't want to speak for Thomas, but I don't know if I would say that I think we're cautious, but I don't necessarily think either of us is bearish. I would always say that if you're gonna force me into one camp or the other, I'm always going to be in the bullish camp. I think the trend is always towards the upside for the market, but I think now is a time certainly for caution. I've said this before, it's not an original thought of mine, but this is a time where you are looking to buy the best and you're looking to forget the rest. And I think that pretty much summarizes what Thomas said. You're going to find a lot of the best in those areas right now. For investors that want to be in something like the tech sector, there's certainly room for growth stocks like Apple and Microsoft. These are companies that have multiple revenue streams. That oftentimes gets lost in the discussion about Apple and even with Microsoft. But these are companies that can make cash a lot of different ways. And oh, by the way, they have a lot of cash on their balance sheets.
Right.
Cash. And that's never a bad company to invest in. I like McDonald's. Right now, the stock's pulling back from an all-time high. If it continues to pull back a little bit, that could be a really interesting buying opportunity for some investors. They've been really able to make this digital pivot very well and almost very seamlessly, showing that something as boring, I guess you'd say, as a fast food space, and they've really kind of transformed themselves. It's a really interesting thing to look at. And then, of course, let's not forget about oil stocks. Don and I were messaging about this just the other day, and I was talking about what a gift the the price of crude was giving to the Fed. And he was remarking that it's not going to last forever, and I agree with him. But now might be a good time to look to buy the dip on some of the oil stocks. You guys know I like Chevron, but there are a lot of good names in this sector.
All right, Chris, we have time for one more. So do you like XLE here as kind of a diversified oil play?
Yeah. I mean, I actually do. I mean, I think actually if you're not going to want to invest in specific stocks, now might be a really good time to start looking for ETFs. And if you're looking in the oil sector, XLE is one that I would look at. Yeah.
Thomas, what are your thoughts on XLE?
XLE is fine. I like the energy sector right now. Even with the price of oil pulling back, it's still well above the levels it's traded for the last decade or more. So the oil companies are going to be flush with cash and paying dividends. Pullbacks would be a good place, a good time to put some more money into the sector. XLE is fine, but I think I've said this before too. You dig into the XLE a little bit, just within the top 5 holdings, you can pick 2 or 3 names like XOM, CVX, I think probably is one of those 2 and beat the yield. So, take the same money that you put into the XLE, split it between two of those top 5 names and get a much better yield.
All right, guys, there you have it. The Fed's latest move indicates potential implications for the market, but while short-term impact may result in a downward pressure on stocks, keeping interest rates unchanged could lead to more attractive valuations and draw investors back in. Thank you guys for your insights, and we'll talk to you soon.
Thanks, Lacey.
Thank you, Lacey.